I ran a scenario just to show you guys an example, and you can play with these numbers as you desire. But in my scenario, I just took a 1,000 acre farm and pretended that the 1,000 acres was 100% tillable, which that won't happen because here in our area of Iowa, western Iowa, you will never get 1,000 acres that's 100% tillable. You might get 85% or so out of your fields. So, it's going to take 1,200 acres to give you 1,000 tillable, something to that nature, because it's measured to centers of roads, which have right of ways and ditches. You have creek bottoms, ponds, maybe some timbers or some trees hang past the borders. You always lose a little. Anyway, regardless, we're going to just make this super simple. And this is a generic. I used 1,000 acres because it was super simple. Very, very, very generic. I tried to keep it half-assed, kind of on a local level. And I recorded multiple sales in the area, so I was able to come up with some price of farmland. So we have 1,000 acres. We're going to split that farm into half corn and half soybeans. And the corn is producing 175 bushels an acre in this area. And this may be a 1 year style example, just again using a rough example here. But at 500 acres of corn, at 175 bushels an acre, 87,500 total bushels of corn, and that corn has maybe an average selling price of $4.19. Gives you $366,625. 500 acres of soybeans at 57 bushels an acre, 28,500 bushels of total soybeans at $10. So you can see we have a gross income of $647,125. So just roughly $650,000. And again, when I was talking about the land, I just took kind of our area, took some past sales, kind of averaged them out, $7,500 an acre. Now, for this scenario, $7,500 an acre, 1,000 acres is about $7.5 million. So, again, 1,000 acres times an average value per acre of $7,500 is a total gross of $7.5 million. Now, for this scenario, let's just pretend that magically out of the sky, half the money came flying into your lap, and you put 50% down on that 1,000 acre farm. And then you went to the bank and borrowed the other 50%. So you're half in debt, half paid off. So the half that you're in debt on, you have a 30-year mortgage, which is right around 6.7% or so right now. And that mortgage payment's going to be about $300,000 a year. So you can see in my column A here, I had what the costs are, and then in column B, I'm just taking the gross minus it. So you immediately take your gross, and you just immediately take off your mortgage payment, $300,000. Then your seed could pretty easily reach $90,000 a year. Take that off. Now you're down to $257,000. Property tax pretty easily $42,000 a year. Maybe it's got a house on it or something. Deduct on column B here. Down $215,000. Crop insurance, I'm just throwing in at $27,000 a year. Maybe you bought a little lighter coverage. You can have some variance there. You're down to $188,000 a year. And hyders for corn currently sits at $865,000, I believe, local. I just threw it out $800,000. I'm throwing out 50 tons for this experiment because you're only doing half the corn. $40,000 down to $148,000. Didn't even put a factor in for lime. Didn't even figure in lime. Dry fertilizer, $60,000 a year, and that's such a variable. I mean, some guys just say screw it and mine it. Other guys, you could dump $100,000 plus. But just for the example here, I just threw in $60,000 at random. That's by no means probably anywhere near enough. Now you're down to $88,000. Chemicals, and I'm not talking a sprayer to run them or anything. I'm just talking going out and buying the chemicals, at some pretty cheap prices. Could pretty easily reach $35,000 a year. And now you're down to $53,000. Diesel fuel, I figured very conservatively, and that's not including running your grease gun or changing the oil in your combine or oil filters and other things. I mean, pretty conservatively though, that your diesel bill could be $8,000. Very conservatively. Down to $45,000. and I put down 10,000 for repairs. And the reason I put down 10,000 for repairs is just because I think even if you didn't have the repairs, you got to figure there's only going to be a certain amount of life in anything, like cutters that engage the ground or anything. So that's a big arbitrary value that could be largely argued. And so now you're down to 35,000. And then, for like a machinery and a personal living, I don't know. I mean, you're down to 35,000 before you factored any machinery costs and any personal living. So I mean, if a machinery, just say you had 1,000 acres, and just say you went out and you wanted to buy a whole range of equipment, not hire it done, but wanted to buy a whole range of equipment. I mean, that's your planter, your tractors, your bush hog for your borders, your sprayer. Maybe you need some sort of a fertilizer applicators. You need a combine that doesn't need repairs, which good luck. 250,000 doesn't go very far buying a whole range of equipment, from A to Z. And $250,000 loan, if you're starting out here, it could be easily 60,000 a year. So then at that point you're negative 25,000, and that still includes no personal living off this at all, none, zero. So where are you making your personal living? And then you got to start begging the question, well, will government payments be enough? Which I was asked that question. Well, if you figured this scenario, that government payment's going to be about $32,000. It wouldn't even come close. You still wouldn't even have anything. What are you going to make, 10,000 a year personal living? I mean, it's not even remotely enough. And you're still going to be shorting something. Short your lime, short your fertilizer, grow more beans. I don't know. Property tax sticks out as a big one. Hydrous is way too high. Way too high. And we've talked about the reasons of why in other videos. That's why it's important that you guys should watch all these series of videos. Obviously, real estate, if you're at 50% debt level, you can't have the higher interest rate loans. And that's why, in a low, shitty dollar environment, commodity prices like we are, you're going to have cheap interest rates. Bring that 300 down to 200,000. Then it starts freeing up a budget. It starts working. So really, the cost to borrow money sits at a higher level than where we previously were, and it obviously doesn't work in a low rate commodity. I mean, you're going to have these kind of prices. You're going to have better commodity prices. That's all there is to it. And what have I been banging the table about? Commodities don't inflation adjust. This is a $20 bill, and say you needed to borrow this $20. So when you go to the bank, banks don't lend money. They create money. And how they create it is they're going to want something in return to hold. So, hey, bank, I want to buy a house for $20. Can you lend me the $20 to buy the house? And the bank's going to say, okay, we will create the $20 so that you can buy the house. But in return, we want to hold the house on our books as collateral until we get our $20 back. Now, where did that bank get the $20? Well, they can borrow it from other banks. Collaterals, can be swapped, or they can use something called the discount window, which is where they borrow it from the Federal Reserve. Now, when they go to the discount window, they borrow it from the Federal Reserve. So when you get your house paid for, and you've given the bank this $20 back, it's you have the house now. They've dropped the value of the house off their collateral, books, and they have the $20 back at their hand. Well, they're not keeping the $20. If they borrowed that money from the Federal Reserve takes that $20 that they digitally created to lend the bank in the first place, and they crinkle it up and it disappears. That's how the money supply stays in check. The only thing that remains in the system is the interest. So they take their 20 back, it's gone. Money was created and now it's destroyed. And then the bank keeps the difference, which is the interest. Now, do you suppose that has anything to do with the fact that these mortgage amounts are all interest up front? That's what I say, they don't care about digitally creating, on paper anyway, the principal. They care about a profit margin, and they care about getting theirs first. Now I'm guessing that's confusing for most of you guys, so let me explain it in a more story style format that will make more sense. So what's a real rate of infinite return? So if you wanted a real rate of infinite return, say you walk into a bank with an idea to build apartments, and you own nothing except the shirt on your back and a good credit score. You have an idea to build an apartment complex in a high growth area that has good tenant potential and good jobs within the area. So you know you're going to be able to keep the apartment full, and you know that the people are willing to pay up a pretty high level of rent, and you know that the building's going to maintain and likely increase in value. The bank sees this plan and agrees to lend you the money to build your apartment. So you take the loan, which is digitally created by the bank, meaning the money is lent into existence. You're building your apartment, and the bank uses that apartment that you just built as the collateral of the loan. Now your apartment's built, you get tenants into your apartment. The tenants pay for the apartment loan, they pay for the repairs, and they pay property tax and all other costs associated with that apartment. That's called positive cash flow. That doesn't mean there's a whole bunch of extra on top of it. It just means that they're covering all the costs associated with that apartment. You go to file your taxes at the end of the year, and you don't pay any tax at all because interest, which as you just saw on that loan, comes all out up front. So interest is tax deductible, as well as repairs and other things. See how you digitally created money? You used collateral as the asset and had other people pay for your collateral. Other people picked up the tab for the whole enchilada. Meanwhile, you paid nothing in tax. Well, around year 10, when those columns start to flip-flop, meaning the principal and the balance, and maybe the building is at a peak time and location, maybe like the job market, everything starts to mature a little bit. You don't want to pay any tax, so you go out and this thing's at the very top of its peak, and the bank sees that you paid it down just a little bit, but the value of the apartments maybe went up again by a third over what it cost to even build, just because of asset appreciation due to it being in the right place at the right time. So you use that collateral, you borrow against it, and when you borrow against it, you go to build another apartment, and you do the same thing on down the line. And this whole time, you're still never paying any tax. Now, in that very first apartment, comes time maybe for repairs, or maybe the real estate starts to look like it's getting sketchy. That's where you jump ship and you use a 1031 like kind of exchange law, real estate exchange, and you can exchange that apartment for something else that also has what they call an infinite return. That's how they get to saying debt is money, because ultimately when they create money, meaning it was originated from borrowing it into existence, they don't really give a damn about the money. They just give it to you. All they care about is the collateral. This is how banks run the world. This is how people with wealth, not being rich, wealth and rich are different. Wealth, meaning the value of something, this is how values, assets get tied up, and almost to the point where you can't get out of it. It's almost a snowball effect, because a lot of those people don't want to pay tax, so they'll just continue to borrow and move on, borrow and move on, borrow and move on. And you can even borrow against those assets and convert that to other things, such as your new Maserati. Now imagine that same scenario for someone wanting to invest in the farmland. So when you start to hear farmers talk about, oh, that'll be corporate owned, I don't quite know where they're getting the term corporate, besides the fact they're probably just saying investor strategy, and the investor that purchased farmland instead of an apartment is just tying it up in some sort of an INC or an LLC. For you guys following the series of videos, which is important that you do because they all connect, I've shown this chart multiple times, just macro trends, 50 years of corn prices. And again, I'm going to point out the stair-stepping effect within the currency devaluations. Currency devaluation, currency devaluation gives you a nice little, higher price point. And we've talked about it on other videos, so I will not be pointing it out again. Now, I'm going to talk about inflation. And I'm going to talk about how price goes up. So in 2008, you had a currency devaluation. And then you saw grain, if you average this out, kind of go up. And then you saw around 14, when the Fed implemented their 2% mandate, it go down. Then you saw the first trade war, we went into a complete sideways trench. Then you saw the OPEC 2020 deal, and we saw an uptrend. Now this is what you call an average. And when you strike an average, you take the highs and lows out, and you just level out the chart, and you can see we've been pretty much flat. Now, when you had a currency devaluation, eventually the price of everything else caught up, and the price kept going up. And then maybe some things went down a little bit, and then they were kind of sideways and flat, but they kept rising. Even the Fed targets 2% a year. That doesn't mean they want to see a drop. It means that they're actually targeting 2% inflation. But when you level this chart out, and if you map all the prices, you can pretty much see that grain has not risen even by 2% per year, and neither have your yields. So if you get a flat grain price and you get inflation that's risen significantly, you just get farther and farther and wider and wider, and pretty soon you have an imbalance. The cost to produce becomes less than other costs. I mean, the whole thing is, it's just simple. Commodities don't inflation adjust, everything else does. And the simple answer to that is because commodities are global. And what you're buying is made here domestically, which is more prone to inflation. It's pretty simple. Just go to Google and you can type in, just enter the maximum, which is around 10 years usually. Longer on this particular chart. I mean, it starts back here on 90, but it'll tell you the length of time. But it's so simple. Just hit the max or hit the 5 year and look how much something's risen. I mean, look at the Dow Jones. And then you can go into Google and you can do the same thing with grains. I mean, look at the 6 months. Look at the 5 years. 5 years went down. Look at maximum. It starts clear back here around 2012. Actually down 31% over that time period. And it's even further proof that when I talk about what we're in a sideways trench, if you followed the last couple videos, I mean, here was a sideways trench in the kind of a downward angle under the first Trump term. Here's the OPEC 2020 disaster, Ukraine invasion, and now we're in a sideways longer term downward trench again. I keep hearing all the time that when grain rises, so does everything else. Well, when grain rises, usually that's at a time of shortages, meaning that there wasn't as much grain, which caused the price of grain to rise. That's inflation. It's especially bad when you have large amounts of printing, meaning there's an extra supply of money, like what happened during the pandemic, chasing that shortage. So you have a shortage and an extra supply of money. Too much money chasing not enough goods. That's when you see your big time inflation, which is what we saw during the pandemic. Too much money chasing too few goods. Now, like I said, inflation hits everything domestically and it stays, while grain doesn't. So during the pandemic, you saw too much money chasing a shortage of goods, which caused increased prices. Following that, commodities returned to more normal because global supplies returned to more normal, yet everything else stayed elevated because currency devalued. Hopefully it's starting to make sense. So when grain rises, so does everything else. Yeah, it's kind of true because usually it's a shortage at the time of printing that causes inflation. That shortage is taken care of by things returning to normal the following years, while the supply of money does not return to normal, meaning a currency devaluation. That's why grains react to supply and demand, and that's why commodity shortages drive inflation. But it's fueled by the Federal Reserve monetizing those shortages. And that's how that gap widens. And eventually the economy doesn't work for anyone. And at some point we'll see what they call a currency reset, which is like pretty much what happened in 01, or 71 I mean, and 08. But if I were to map that personally, I would say that probably won't happen for at least another 5 to 7 years. Which is why I firmly believe that we're in a sideways tranche. As long as inflation keeps trending lower, which there's fundamentals of support it will, and fundamentals of support it won't. And in my opinion, we end in recession probably mid-26, early 27. An actual recession, not like the one that we're kind of in right now, that doesn't meet qualifications to actually be, quote, in one. And recessions are deflationary, so I would look for grain to trade sideways with a low sloping downward line. And that doesn't spell good with other things not declining. This has been a, I think, 4-year now national average, statistical average, meaning on a nationwide basis, that farmers have operated at a loss. And these losses have been at record dollars per acre. And that's non-inflation adjusted, of course, but it's still not a pretty picture. And when you get into an economic environment like we're in, farmers become envious. They start paying high cash rent. They start actually producing more volume. You know, if I can farm that road ditch over there and get an extra 200 bushels, that might be what it takes to get through the year. That kind of mentality, which is totally opposite of what really needs to happen. Farmers start taking risks and working for pennies on the dollar while other farms collapse. The government payments that we're going to receive are by no means even close to enough to offset the losses, and they wonder why nobody's young is entering into the business. And you can see that by the way the video opened up in the numbers, and those are just one set of hypotheticals. You could run it in multiple different ways, but the outcome's still not good. For myself, I grew up on a farm, worked on the farm through all the years. Of course, the 90s were better than the 80s. The early 2000s, which is really where I kind of hit my stride, was pretty good years from, say, 03 to 12. Every year was better than the year prior. You left the farm in better shape, and it was fun. You're always moving forward. You're able to build a business and operate things like they should be. And then I entered the earth-moving business, which really took off during that time period, and was 14 through 16 was some pretty good years for me. And then by 18, under Trump's first term, when those tariffs came on, the earth-moving really began to decline. We had to start going after more commercial stuff. And I was still young enough then. I probably should have, during that time period, I should have probably been pursuing other careers, meaning taking my excavation business and expanding it and probably leaving the farm behind. And I didn't do it, and that was a big mistake on my end as I returned to the farm. My father's getting pretty old, and I returned, essentially to full-time farming. And I don't own anything yet, but I did return to it basically full-time around 2018. And look what it's done ever since. I mean, we're going to be talking an 18 through a 28 time period where you essentially had no profit margin at all. I mean, it's just you take maybe a couple good years in there, then offset it by the loss years, and you average it all out over those 10 years, and you've made nothing. Which ultimately makes me feel like I've just wasted 10 to 15 years of my life. And ultimately probably put myself in a worse situation I could have just walked away from 10 years prior. I'd read a book clear back years ago. It's called Rich Dad Poor Dad by Robert Kiyosaki. He's an investor. And then, just over life here, just some of these struggles over the last 15 years or so, 20 years. I've really got into chasing the money trail and discovering how this all works. And the more that you learn, just the worse the picture gets. When you look at charts such as the Dow Jones Index, and you can see that it's gained around 10% per year. Meanwhile, grains have ultimately been flat, or maybe in some cases, some grains in long-term deflation. It's easy to see why there's not large investment into that industry. In my opinion, a farmer should be able to be 50% in land debt by, a new planter, or, reasonable. I mean, you can't go out and buy a 32-row Bower bar for 200 acres, but, you should be able to buy a size-appropriated planter and a new tractor to pull it with, and still make enough money to feed your family. And I don't feel like that's an unreasonable request. That would have to look at profit margins somewhere around 15% or better. At that point, you're only really competing with other industries. Farming, if you go to any Google index and just look up profit margins by industry, agriculture ranks at the very, very bottom. And there's not really a reason it should. We were just talking about how when grain goes up, things go up. I mean, here's land prices. You can take any county. So here's a county in Iowa, and you can look here. Like here was the '08 currency devaluation, and obviously grain went way up. Why did grain go way up? I mean, what happened first? Let's just say what happened first. Well, what happened first? You had a shortage of something. The shortage of something came at a time of printing. So you had the 2008 started quantitative easing. So you had a shortage and you had too much money chasing it. What happened? Well, that money ended up inevitably flowing into the land. So you went from just '04 to, say, just 8 years later, a large jump. And you can see these prices. I mean, you guys zoom in on the screen, you can see the prices. Or Google it yourself. It's just Iowa State farmland prices by county. It's not a hard thing to Google. But prices went up. And then, by 15 or so, prices are lower than '08, and ground stayed elevated. This is how ground has risen in Iowa statistically by 6.7% per year. Take your own farm. Did your gross income go up? And if it did, answer why. Was it because you took on additional acres? Was it because you had better yields consecutively every single year? Or did your yields go up, then maybe back down the next year, then kind of average out? What I'll bet most farmers find out, if they really check their books longer term, like say over 10, 12 years, is they haven't even kept up with inflation. I mean, if inflation is targeted at 2%, the CPI is low, figure at least 3.5%. Did your farm grow by 3.5%? Not meaning in acres, meaning in buying capacity? Well, if you're a row cropper, small grains, it probably didn't. Meanwhile, your land and your tractor, various other things, rose excessively, greater than 5% per year. And that gap is precisely why we're in a problem. Now, if you want to break that down to a tractor, I mean, you could take a John Deere 8330 at $165,000 new, or the current modern day replacement for $550,000, which is really easy to see. The same machine essentially, not being able to physically do any more actual work. You can see why nobody can afford it. I mean, you would have to get twice the output out of that machine. to be able to afford it. And that's why worker productivity is going through the roof. Because it's not only agriculture, it's everybody else too. Wages, they haven't kept up with inflation. Inflation's a hidden tax. It takes away your buying capability. I highly doubt that the government would get away with taxing people another 2-3 trillion a year. So they just deficit spend it, borrow it. And it acts just like a tax because it inevitably decreases your buying capacity, just like a tax coming out of your paycheck does. It pulls away from your buying ability because it's money being removed. It's purchasing power being removed. Now, if you were to have these shortages and you didn't have all this printing, then you probably wouldn't have the large booms followed immediately by bust cycles. So inevitably, the Federal Reserve and the way this whole monetary system is structured has made things worse. And right now we're in that bust cycle. I don't think it can last like that last tranche. I don't think we can be in a 5 to 7 year sideways because you can't afford to lose money. I mean, farmers are already in bad shape. They weren't in very good shape prior to the pandemic, and it's worse now. And we're 6 years past the pandemic. So that's why when I forecast, I start to look at what's going on, and I start to look at bad energy policies currently being put forth by the administration. And I think that those policies will inevitably lead to higher soft commodities down the road. And there could become a time where we'll see more of a biofuels push just due to shortages, especially if something geopolitically blows up big. But just looking at the cycles on paper, we're probably still going to be a few years away from that. So it's going to be a struggle. These desperate times are what gets a lot of farmers on social media with their misinformation. It's what makes a lot of people suffer in silence, meaning that like you can talk to somebody 300 miles away and they're about ready to shoot themselves, and yet your neighbor somehow is doing wonderfully because they don't want anybody to know that they're suffering quietly under the table. They'd rather just keep that between them and the banker personally rather than the banker find out about it through rumor. Even myself, I have to be careful what I put on this social media platform. I think some of the people on social media are looking to become the next millennial farmer or strike it rich, while others are just hoping to somehow bring awareness while blaming the wrong things at the same time. And that was the point of this channel, was to kind of clear up some of those misconceptions and hopefully spread awareness. And for about the 150 of you that seem to really hang into the channel, thanks for watching. Appreciate it. That's why I keep doing these. Oh, and if you're wondering what the background noise is, well, that's my son who woke up entirely way too early this morning, having a fit at his mother. The joys. Alright, see you in the next one.